Right, so where do we go from here? Now, I've just put up a video yesterday saying that I'd give you my strategy for, well, the overall markets going into the weeks, days, months even that lie ahead. So I'm going to have a look at the broader markets very quickly, and then we'll go into individual currency pairs. I'm going to say right at the beginning that the two instruments or pairs or tradable things that I'm interested in mostly right now are the pound against the US dollar and the Canadian dollar. So just remember these: the pound, British pound against the Canadian US dollar, and gold. I'm going to tell you why a little bit later on as we progress through here. But let's have a look at what we've got first of all. And I'm going to start with the stock markets, and we'll have a look at NASDAQ. So let's just have a look at that now. Sorry, that's the US dollar index. We'll come back to that. But let's start with the NASDAQ. Now, remember in my last video when I was walking down the street, I said that after Jackson Hole and Fed Chairman Powell's talk, which was terse and abrupt and brief and very, very clear regarding interest rates and inflation. And the overall message is that we're not going to be easing up on interest rate hikes anytime soon. And the Fed's overarching objective is to reduce inflation down to, well, it sounds ridiculous when you say it right now, but down to an acceptable level of around about 2%. Right now, it's up near 10%. Well, I think it was 8.9 or 9.1 on the last meeting. And we'll find out more about that on Wednesday, I think it is this week, when the CPI numbers come out. But the overarching message is we're not going to be seeing any cuts in interest rates, and therefore there's going to be support for the dollar, which is negative for currencies, other currencies in general, and we're going to see resistance to any increase in the stock markets. And I'm having a look at the NASDAQ here, but we could apply that to the S&P and the Dow and so on. And so the overall idea here is to sell into rallies or range trade. Now, we've got two levels on this chart, and it's pretty simple. I could add some more. In fact, let's just put one more in. But we're not going to be bothered with that too much, and that's that one up there. And we're right down at the bottom of this range, which is between 12,900-ish and 12,100-ish. And we're right at the bottom of that. On Friday, we saw the NASDAQ rally and then drop dramatically. I've explained the reasons I feel that happened during my walk and talk and chat about markets in general. So we'll be looking to actually sell on rallies. Now, these are very difficult times to be trading because we've got an overall bearish market in NASDAQ and S&P and Dow. The reason I'm talking about stock markets is because stocks and currencies, particularly the US dollar, are intimately linked to each other. So what happens in the overall market affects currencies as well, obviously. So we're right down at the bottom here. We've given back over the last week or two a large portion of this, what might now be termed a bear market rally, and we're heading back down towards the downside. So any opportunities to sell the NASDAQ should be considered probably the best chance of getting anything out of this market at all. There will be opportunities, like I saw on Friday, to buy the dip. So on Friday, the market actually rallied up quite dramatically, all the way up to about 12,450 and then dropped back down again. Not really closing particularly weak at the end of the day. We saw a bit of a bounce off the bottom towards the end of play, the last hour or two before yesterday's market closed. So, but there again, I think any opportunities to sell the NASDAQ on rallies, and the obvious levels can be determined really by anything that you want. The easiest is, this is a day chart, the easiest is to look at the moving averages. You can see we rallied up to the 100-day and the 50-day moving average on Friday, and that's where we started to see the sell-off and back down again. So any rally up to these moving averages is a good place to sell. You could draw on here other horizontal lines, Fibonacci lines, whatever you wish, So let's just move this one down. So we can draw one at Friday's high right there. There's an obvious line there. So we're in this range now between these two levels, these two gray lines, which represent support and resistance, between 12,500 and 12,100. Call it 12,000, actually, which is where that support level is. So that's the kind of idea. Sell into rallies or play the range. There will be opportunities to buy on dips if you look to trade off hourly or even shorter term charts, and you'll be able to buy into dips. Look for a change around on the short term charts to buy into any bounces down to key levels. We could put some more key levels in here. You can draw them all the way down. And really, actually, what I do is if we see something like a 1% to 2%, even 3% move in either direction, those are good levels to sell or buy into. So between 1 and 3% move, when you start to see a change in momentum, you start to see an opportunity at a particular level, those would be good opportunities to buy or sell. But the overall bias on NASDAQ is definitely down. Not only because the chart technically shows us that, but I'm going to draw some more levels in here. Let's just try and so there's another one down here. This is a pretty key level. That should be at 11,830 or 20. You can see I've cut off the bottoms of these wicks below us, below that support. I'm looking at the bodies of these candles all along here, and then I could even put another one at the bottom of those wicks. So just simply draw these levels into your charts and look for strong moves. These are price magnet levels, so there's another good one there, right there. That's an excellent level, 11,480, call it 11,500. You can see it's at the bottom of all of these spikes and simultaneously at the bottom of the bodies of these candles. So if you get a dip down to any of these levels, you can look to buy. Strategy, if you're going to be buying, use small amounts. Be prepared to be nimble and quick. If you're going to be selling, be prepared to hold for longer. Look for bigger positions and longer term moves. So that's NASDAQ. Pretty simple, really. Sell rallies, buy dips, position your buy trades on dips smaller, look for less profits, and look to hold into those selling positions, your shorts. Look to position those up a little bit better, a little bit more size on them, and be prepared to hold those for a bit longer. Let's have a look at gold. This is one that I said earlier on I'm particularly interested in. Gold, I think we're at pretty crucial levels right now. This one here that we bounced off yesterday at around 1,700, it actually got down to 1,690 just poking through. I had my buy orders precisely at that level, and I took several trades. We bounced around a little bit. I'm going to show you why. So that level right there, 1,690. I was in at, I think, 1,700, slightly higher than the low, but not much. But the level precisely is actually 1,697, 696.2 if you want to be more precise. The bottom of the bodies of these candles, and you can see how beautifully we bounced off there. So I bought gold there. I'm looking to continue to buy gold into rallies, into dips. So I've got a small position that I've held over the weekend on gold. But any dips further down, and particularly if we get down to 1680 or 1685, I'll be looking to add more. Now, the reason this is pretty simple is because if we break below that level, let's just zoom out a bit. If we break below that level, this last line here at 1,680, well, barring a false break or a spike below, which is not going to last, we're probably headed for quite a lot more downside on gold. So we know where the barrier is on this. We know where we need to get out, which is really important. It's just as important, and perhaps even more important, to know when to get out of a losing trade as it is to get into a winning trade. So as long as we hold beneath that level, that's the line in the sand, 1,680, those lows there. If we break beneath there, well, I think we'll be heading down quite a lot lower, and we could be heading into 1,600, possibly 1,550, and even as low as 1,450. I don't think that's going to happen. I think gold still remains to be a risk-off proposition. I think the markets are going to get more difficult. I think we're going to see a lot more weakness. I don't know, it's just a supposition, but we're going to see a lot more weakness in stock markets, and there's going to be turmoil in currencies. There's going to be all sorts of problems in trading. And I think the safest bet, the safest area, as it always is, will be gold. And if you're going to position into anything with a bit of confidence, I think gold is the one. So that's my strategy, actually, and has been for the last 2 weeks. And I'm going to continue to look to buy gold. So there's a tip. You can put that in your trading pipe and smoke it. But I think it's a good one. And what's beautiful about it is 1680, that line at the bottom of the chart, we know when we're wrong. And as I said, that's really important to have that level to know when you're wrong. So as long as we're above being wrong, above 1680, the level of potentially point of no return, as long as we're above there, I don't mean no return, I mean no near-term return. As long as we're above there, look to buy into gold. I think we're going to see a move back up to 1750, and then back all the way back up to where we were just a few weeks ago at around 1800. And then with a bit of luck, we'll move up to these moving averages with a bit of a mean reversion up to 1820, 1835, and then perhaps even higher still, depending on what happens in the stock markets. I think gold is becoming more attractive. It has sold off a lot in recent times, along with some of the other metals like copper and silver. But I think it's an interesting opportunity, and one that I'm certainly looking at strongly. Now, I know it's not a currency, and I know this is a currency trading website, YouTube channel, but sometimes you've got to diversify, and particularly in difficult markets. And as I said in my last video, I've been trading a lot of things that are not dollar related and not even currency related. I've been trading the NASDAQ, given you my strategy on that: sell into rallies, larger positions, buy smaller positions on dips when you get a chance. When we've moved about 1 to 3% intraday, look for reversal areas, look for those key levels on the charts, and try and buy into dips, but with smaller positions, more nimbleness and less willingness to hold on. Look to sell into rallies with more determination, more size, and a longer term view in mind. And that's a technical view, but it's also a fundamental view, simply based on just a few words that Fed Chairman Powell said at Jackson Hole. Let's have a look at the dollar index. Now, this is where things start to get tricky, because currencies are not easy right now. A lot of you will be saying, well, currency trading is pretty simple. Follow the trend. Yeah, sure. I'll tell you why that's not going to be so easy right now. Let's start with the dollar index. You can see there's the blue trend line, dollar index moving higher. We've got to 22-year highs just a few days, on Thursday actually, at 110. On Friday, along with the rally in the stock markets, the dollar began to fall, but only down to the trend line, and then bounced back up again as stocks began to fall. So where do we go from here? Well, who knows? That's the answer. Now, if I could predict the currency market, if anyone could, they'd be incredibly wealthy. Now, don't listen to these people on the internet that say they know where it's going. They know what's going to happen. Follow the trend. It's very, very simple. No, it's not that simple. If it were that simple, they'd all be billionaires and even trillionaires, because if you could predict markets with such certainty, then there'd be no risk involved, and you'd be able to take any trade that you wanted with the certainty of it working out. It doesn't work like that in real life, and we don't know what's going to happen. We don't know what's going to happen in stocks. We don't know what's going to happen in gold or other metals. We don't know what's going to happen in commodities, and we don't know what's going to happen in the dollar index. The dollar index measures the strength or weakness of the dollar compared to a basket of other currencies, with the euro, the pound, and the Japanese yen being the main contributor towards that index. And then there are a variety of, I think there are about 10 or 12 other, in total, actually, currencies that contribute towards that index. But with the euro, the pound, and the yen being, and I think then you could add in the Swiss franc, Canadian dollar, and a couple of others. But those top three, the main that's why they call the majors, are the main contributors. Looking at this chart, what we saw on Friday, this drop down to the trend line, rally back up again. Unfortunately, all we've managed to do there is to form a potential reversal pattern. Yes, we've got a long spike at the bottom, indicating that there was a lot of buying interest at the bottom there. There was, but we didn't manage to close higher. And we formed this, hanging man type of candle. That's a kind of indecision candle, but actually bordering on a reversal candle. And I don't know what's going to happen. I think there are some clues, though. So let's have a look at some of the individual currencies to give us some clues. So what we want to know as currency traders is which general direction we should be trading in. And looking at this, well, it's very difficult to tell. Yes, we've got a long wick. It's kind of bullish. We've held above the trend line, but this is not a very decisive bullish candle at all. It's potentially a reversal candle. We're at 22-year highs. We're incredibly overbought on the dollar. If you have a look at the longer term view, you can see where we are. We're not anywhere near the highs that the dollar has been at in the past, beyond 22 years ago. But look where the 200 period moving average is. Look where the support lines are. Look where the 100-day moving average is. And we're actually significantly above the 50 and the 20-day moving average as well. So, but from where we are now to around about 109, 110, down to the 200-day moving average, they're about it's about a 10% drop back down there. So we're about 10% overvalued on the dollar in very simplistic terms, perhaps not in fundamental terms, but technically about 10% overvalued, which means we could correct down to the low 100s, maybe 105. That's this line here. This is an interesting level, kind of like it's where the 100-day moving average is, and it's where a previous reversal support and resistance level occurred some time back during, I think it was the beginning part of August or end of July. So interesting. Are we going to be short the dollar or long the dollar? If you look at this, we have to remain bullish on the dollar. There's no doubt about that. I'm not denying that at all. I'm not trying to be totally contrarian on this, and I'm not trying to fight the trend at all. But there are some things. Now, whilst we're on this page, there's one more thing I want to show you, which is something that I've just got into. You'll have known if you've followed my videos and tweets over the months, and it's probably almost a year now since I started this channel and the Twitter feed. I buy periodically. I buy this pair, the British pound, South African rand. It's not just because I happen to live in South Africa, but it's an interesting pair. I expect that overall we're going to continue to see weakness in the South African rand. There are a lot of reasons for that, fundamental reasons. But also technically on the chart, it looks really good. I just bought at around 19.9 at the bottom of the spike against the 100-day moving average. So I bought there actually about, I think, 1990. So not quite at the bottom, but pretty close. And this is more of a long-term play. I'm just putting this up here out of interest for those of you who want to trade more exotic currencies. I expect that this trend line will hold. This channel needs to be tested at the top, this channel here. And by the time we get to the top of this channel, we should be around about 21.2. And we're at just around 20 now. So that's kind of perhaps a 10% decline in this currency, the rand against the British pound. The reason I like this is because the British pound is so oversold against everything. You can trade the South African rand against the dollar as well, but the dollar has been strong. The pound has been weak. I think the pound is going to need to regain some strength. We're going to have a look at the pound chart just now. I don't want to be buying this pair in the dollar sense, but I like it in the pound combination. And I think we're going to see a nice move up to the top of this channel. I could be wrong. If I'm wrong, we'll get down below this level. Actually, going to move this line slightly lower. That's the being wrong. The first being wrong area is about 19.65, 19.6. And the second part of being wrong, really wrong, is a little bit lower. And that would be at this level here, which is at 19.44. So those are the two key levels, very, very important. But hopefully we'll hold above this bottom channel line. We need to break through this downward trend line, and we're kind of neatly boxed in. I like it when we get boxes like this. Actually, it's quite interesting. You can trade box options. It kind of reminds me of a box option play, this. We're in this box. If I copy this line, actually, just let's make it interesting and put it to the to the left-hand side to form the other side of the box. There's our little box. It's almost, some might say, a bearish flag, but I don't think so. I think we've got a box that needs to be broken out of, and we need to move up to the top of this channel line. So let me just get rid of that. That's just a bias, by the way, for those of you who are interested in slightly different currency pairs. And also, this is a longer term ploy. I think I'll be looking to hold this for weeks and perhaps even months. And I've got about an unleveraged position on it, but it's a reasonably sized position, but it's definitely not leveraged. So I'm at about a 0.5 to 1 leverage on this. So so I'm not even with a full size position. But if we do move up 10%, it'll be a 5% gain for doing nothing really, just letting it do its thing. So that's that, for those of you interested in. So we've had a look at the broader market perspective. Now let's go and have a look at the individual currencies, and I'll tell you which ones I like and why when we get to there. Okay, so let's have a look at the euro. We'll go through these one by one. I'm not particularly interested in trading the euro right now. I don't know what's going to happen. It looks very weak. It looks pathetic. It looks like, we're holding beneath. We're at 0.9950 right now. I've been playing this range, buying at the bottom. I haven't really been selling at the top because I'm not convinced of the down move, but I've been feeling that buying at the bottom has been a good idea. I've been in and out about 4 or 5 times over the last period, buying the euro at the bottom. But every time I'm hoping, and I get out of half my position at the top of this range, and I hold on to the rest, hoping for a move back up, but the rest always just comes back down and stops me out generally at break even. So not looking particularly interesting. What's concerning about the euro on the longer term view is if I have a look at the weekly chart. So we're in this downward channel. We've got actually I want to have a look at the monthly chart on this. And I don't think you can see it on Oanda, but if I switch this across to FXCM, I get a longer term perspective on this. So there we are on, this is the FXCM chart, which gives us a little bit further back. And there we are down here on the euro right now. Yeah, there is some support going back to this period here in the, I don't know, I can't see on the chart, 1989. So we're at the levels of 1989. That's a very long time ago, 1990, 23 years ago. We're looking back at a support from 23 years ago. But if we just have a look at the potential for this to go even lower, just based really on this very, not even particularly strong support, going back to there, we get to, I've just got to change quickly, whoops. I've just got to change the scale. Yeah, so this line here goes, this one here, it's a pretty weak support. It's not fantastic. Is at 0.9532. We're at 0.99. So that's 400 pips lower, that support. And it's not even a really major support. We've got a little bit over there as well. This is a monthly chart, remember, so we're looking at a very long-term view going back into the 80s. But we could still there's even more opportunity for this to go down, scarily. And if we could go all the way back down to this support at around about 2000, we're down at 0.82. That's the potential. and even further. Now we've got another one down here at 0.76. This is going back to 1980. Okay, fair enough. It's 40 years ago, but and we are oversold on this currency. But there's plenty of space to the downside. I don't think it's worthwhile gambling and betting on the euro finding support here. It may well do so. Of course it could. And it all depends on what happens with the dollar, what happens with the stock markets, what happens with gold, what happens with all sorts of things, inflation. We're in a very, very tricky time right now, and I don't want you to be betting all of your money on the fact that, yes, we're oversold on the euro. Yes, it looks like the dollar's kind of needs a retracement or a correction. It doesn't need to do so. If you have a look at the dollar index on a similar perspective, let's see if we can do that going back for a similar time frame. So there we go, back to back to 2000. Let's use that as an example. Same sort of thing. This is a monthly chart, so these are the lines we drew on the daily chart, so they look a bit weird here. But look above us. There's space to go all the way up, at least to 120 on the dollar index. We're at about 110 now, so we could lose another 10% on the dollar at this time. Now that's pretty scary. If you're in leveraged short positions on the dollar, i.e. long positions on the euro, long positions on the pound, long positions on the Swiss franc or the yen, you could be in for a very, very tough time. It's time to be careful. It's time to be serious about your trading and not risk everything on just what you think. Yes, we are overbought. Even on the monthly chart of the dollar index, let's have a look. We're right up here. Look where the moving averages are. They're all stuck together down here in the around about the 90, let's call it the 100 level, 90, 95, 96, 97. They're all stuck down here. We're miles above them. But it's happened on occasions quite often before. Look at this time here, miles below these moving averages over here. So it really means very little. The market can continue quite easily to be highly irrational for a much longer time, as you've heard many times before. Then you can remain solvent. So we don't want to get stuck in that. But what I do like out of currencies, and I'm going to switch to the British pound and have a look at the same sort of perspective on this. And this is where I'm actually more interested in trading. So forget the euro for now, unless you want to lose your shirt by betting against the dollar and betting on the side of the euro. If you're going to be doing that, let's have a look at the pound. The pound is more oversold than the euro. The pound against the dollar. The pound's more oversold against most currencies than the dollar is. It's more oversold against the Canadian dollar. It's more oversold against a whole bunch of currencies. And again, I'm going to go to FXCM because we can get a longer term view on this. But there's the pound. Now look where we are. Let's get rid of this. This was my idea on Head and Shoulders, which didn't work out. But that's okay. There's the pound. This is a monthly chart on the pound. Look where we are at the moment. Look where this low is here. This low here, going back to 2020. And that low was about 1,000. Sorry, I'm getting mixed up with currencies and different denominations. So 1.14, thereabouts. Call it 1.1430, 50, roughly 1.14 in 2020. We're about there now. We're just slightly higher, 100 pips higher, not much. So that's in 2020. Look how oversold the pound is overall, not just on the short-term move down, but generally overall. The pound has gone from $2 to the pound down to about just over $1 to the pound. So incredibly weak. But have a look at where we are overall, going back into the 70s. The only time we've been lower than where we are right now on the pound was in 1985, is it? 1985, April 1985, we got down to 1.0477, or call it 1.05. We're at 1.15 right now. But we've got crucial support here. Now, if you compare this to the euro chart, you'll see that the euro didn't actually have these lows in place, not recently anyway. The euro has been much weaker than it is right now on numerous occasions. That's what I'm trying to say. The euro has often been weaker than where we are right now. The euro is not as oversold as the pound, and the pound fundamentally, I think, has fewer problems in a broader economic perspective than the euro does. And it's incredibly oversold on the short term and on the long term. So I think fundamentally the pound should be stronger. I think technically the pound should be stronger. And we've got very beautiful and crucial support that we're just about at the moment. All right there. So we're just about at the spike low support. Look what happened last time we got there, incidentally, out of interest. We went in 1 month, we went from 1.14, let's call it 1450. We went from 1450 to 1.24. So in this month, from the low, in 1 month, bear in mind, from the low back to the close of that month, we rallied 1,000 pips. That's a lot of pips. That's a big rally, significant rally. And we're back down to the same level where we saw this incredibly dramatic spike. I like the pound. To buy, that's where I'm trading my currencies right now. Not only against the US dollar, but also against the Canadian dollar. And there we go, Canadian dollar. We closed right at the lows on Friday. Didn't on the pound. Let's just go back on the dot against the US dollar. Let's just have a look at how we closed on the US dollar on Friday. We want the day chart. How do we get the day chart? There we go. Okay, so yeah, we did actually close near the lows on Friday, but a little bit of a bounce on Friday on the pound against the US dollar. Not much, but a tiny bounce. But we didn't close beneath the previous day's lows. That was Thursday, that was Friday. But against the Canadian dollar, we closed quite a lot lower than the Thursday close that you can see there. So quite a lot lower and much weaker at the close of play on Friday. So what does that tell us about the Canadian dollar? Well, let's have a look at the same thing. Let's have a look at the monthly chart and let's see where we are. There's the monthly chart, Canadian dollar. That's the US dollar. We just looked at that. Come on, James. Get with the program. So while I'm busy fiddling around this, please go and press the like button. Give it a little squeeze. Tell it that you love it. And subscribe to this channel. It would be great. Now, here's the Canadian dollar on a monthly chart. And again, I'm going to switch to FXCM. I don't know why Oanda doesn't have the data that FXCM does. Let's just get rid of these. And this. They just annoy me and clutter up the chart. So, all right, here we go. Canadian dollar. A little bit similar to the pound against the US dollar. However, we are closer to this 2010 low. The other one was 2020 on the euro, I think, on the US dollar. But have a look at that. We're very, very close to this 2010 low, which is also, coincidentally, very close to this 1985 low. There's not a lot of distance between that low and where we are at the moment. So we're really at, if we broke beneath, think about it like this, if we broke beneath 1.46, so we're at 1.51 right now, so 500 pips below us, 500 pips below us. If we broke below there, that would be the lowest price that the pound has ever been against the Canadian dollar, lower than the lowest price. When I say ever been, well, we're going back into the 70s and maybe early 70s. Yeah, I don't know what happened before that. We're also only a little bit above 1.4850. We're at 1.51 right now. So we're very close to this low from 2010. and we're right at, or just slightly below, this low from 2013. I like this pair. I think there's not very much to go on the downside before we reach incredibly critical levels, which I don't think we're going to break unless something really horribly goes wrong in the market. We know these levels are very clear at about 1.4650 and at about 1.49, and we're at 5.1 right now. So I'm favoring the long side on this pair. So let me just try and summarize this for you. Because we're in extremely risky markets, because we're experiencing potentially unprecedented turmoil. We've got war going on. We've got inflation rates, which are the highest in, I think it's 40 years. We've got the dollar at 22-year highs. We've got the pound and the euro and the yen all at extreme levels. And these are levels at which everything is going to happen. It doesn't mean because we're at extreme levels that we can't go beyond them, of course. It doesn't mean because we're overbought or oversold we can't carry on being in that situation. It doesn't mean any of that. But it does mean that we're going to experience volatility, uncertainty, toing and froing, large swings. Expect a lot of volatility, particularly when important numbers come out, which the Fed will be looking at. Remember, they said they're going to be data-driven. They're going to be interested to see what things like jobs. That's why there was such a volatile move on Friday with the non-farm payrolls being pretty good, like really good, but not as good as the previous month. The market didn't know how to react. They forgot about Jackson Hole. They decided that the Fed might begin to go easy on interest rates, but then they remembered what the very terse and direct and blunt Fed Chairman Powell said, and they realized actually that's not going to happen. Even a really good jobs number doesn't mean that they're going to change their position. In fact, they realize that a good jobs number means that the Fed will probably carry on feeling more confident about raising interest rates, and therefore, on that basis, stock markets dropped, the dollar rallied. So we're going to see a lot of toing and froing when the numbers come out. Powell has said repeatedly it's going to be data-driven, so he's going to be interested in see what the numbers are. Those numbers will be jobs, CPI, PPI, things like pricing in commodities like oil and natural gas, and all of those numbers are going to swing the market dramatically, violently, uncharacteristically, and possibly irrationally. So we've got to be prepared for that. So what do? We go to the places where we think that there's least risk and the most probability of upside. I think it's the pound against the US dollar, the pound against the Canadian dollar, and even the pound against the Swiss franc. That's another interesting one. So I'm in all three of these, all of these pairs. Let's have a look at the pound against the Swiss franc, if we can just find that. And the other one we haven't talked about is the Japanese yen, which I'll talk about shortly. Here's the pound against the Swiss franc. And let me just quickly switch this one to FXCM as well. All right, so there's a problem on this chart. Going back to 1974, it's a hell of a long way. It's actually, I was 8 years old when this happened. Look at what happened there. I can't even remember what the reason for that was because I was 8 years old. Maybe that's just a glitch on the chart. I have no idea. But let's try and ignore that. Let's go back to, goodness gracious. So this is a month chart, pound against the Swiss franc. Let's go back, I don't know. Let's get rid of that because it messes up all the charts. Anyway, going back to the 80s and late 70s, we're at the lowest level we've been in all of that time, 40, 50 years. Okay, another one. Doesn't mean we can't go lower by any means. But I kind of favor this one. I'm in this with a little position. I'm prepared to hold on to this. Again, if you look at the daily chart, it's oversold. And is this the right one? No, that's not the right one. There's a problem with, we don't want that. We want, let's have a look at the 4-hour chart. And I don't know what these are. Yeah, so Why have I got ranges? We don't want ranges. We want, no, we don't want that. Just give me a little, so that's 1 month, 1 week, 1 day. Is that a day chart? Yeah, so we write, so there we go. Sorry about the faffing about there. So we closed at 1 point, call it 1.13, pretty much 40-year lows. I think the pound it's the weakest of all of the majors. It's at critical levels against the US dollar, the Canadian dollar, the Swiss franc. And it probably is against the Australian dollar as well. I don't know. And no idea. I haven't looked at that. I don't even know if you can trade that. I'm sure you probably can. Pound, Australian dollar, maybe. But I think this is a good idea for a buy. The downside is pretty minimal. I'm going with very tiny positions, very small positions, willing to add a little bit more if it drops further, and looking for a rally back up to maybe 1.17, somewhere around there. Perhaps, obviously, the first stop would be 1.15. We're at 1.13 right now. So I'm in that one with a very small position. I'm in the pound CAD with a little bit more. I'm in the pound US dollar with a little bit less. Those are my currency ploys. I'm not prepared to go with the euro. I'm not prepared to go, oh, there is one more that I'm in, actually. I need to point that out to you quickly. As I said, I'd give you my strategy going forward into this. I've told you about the pound South African rand. I think that one's going to be a good one. So you can see they're all pound based, actually. So I've got pound in against three currencies. If I'm wrong on any of those, I'll know pretty quickly. If I'm wrong on gold, I'll know pretty quickly. Okay, so we've had a look at the gold chart. So I'm in things where I know when I'm wrong, which is cool. So pound against the US dollar, pound against the Canadian dollar, pound against the Swiss franc, and gold. The only other thing, and I've been trading natural gas. I'm not going to talk about that today, but I'm basically selling natural gas on rallies. For those of you interested in natural gas, if you want some ideas on that, just please leave a comment below, and I'll get back to you on that. I'll tell you what I've been doing. I've actually made some really good trades on natural gas selling into rallies. But the other one that I wanted to talk about was the well, let's talk about both the euro Japanese yen. We can talk about so the euro Japanese yen. Let's have a look at a day chart. So that's 1 day. We had a bit of a reversal. We've got some resistance here, right here, the euro Japanese yen. There, this line. If I just draw a horizontal line in there. I did put this idea up on Twitter. No, we don't want that. I put this idea up on Twitter a few days ago, and so far it's looking quite good. I was in this, but I'm going to reconsider this on Tuesday because I'm not 100% sure about it. But we've got a spike high through that resistance, potential head and shoulders pattern. So there's the left side, shoulder, head, potentially a shoulder now, and then back down to, well, at least 133.70, and then potentially down to 126, 127, somewhere around there, 125. So that one looks good, but but I'm going to wait. I want to see what happens on Tuesday because we've got the spike high through resistance, through the shoulder line, so to speak. Are we going to manage to hold against there? If you are going to short this one, euro Japanese yen, wait for a rally back up to sort of halfway up through this candle, up to this black line at 140. Wait for a rally back up to 140, maybe 140.2, 140.20. So 140, 140.20. Try and sell at those levels. But again, use stop losses and go with a small position. And what's nice about this one, if it does work out, if you go with a small position, that's going to be fine because there's a very, very large potential to the downside. And you can get out for a very low risk, small stop loss, small position. You're not going to lose very much if you take this. I'm going to consider this. Actually, I'll probably put some orders in. I'm just thinking about it now. When I make these videos, I kind of think as I make them. So I'm going through my process of analysis with you as I'm doing it. I haven't pre-prepared these videos. I'm just telling you what I'm seeing on the charts as we go through them. I've got my ideas already on the pound that I've told you about. I'm already positioned on those, but now looking at the euro yen. Okay, so I think 140, 140.20. I'm going to look at positioning some orders in there with tight stop losses above this high, wherever that is, at 141. I'd go for 141.10, something like that, and with an out at around 135, down towards this 200-day moving average, and then potentially, so let's call it 135, maybe 132, and even if we get some very dramatic moves, all the way back down to 125. So I think that looks good. So I'm going to give that one a little go. Small positions, 140, 140.20 to sell for a move down, stop loss above that spike at 141.10. And the other one I wanted to point out very quickly before we go is dollar Japanese yen. Same sort of thing here, really. We reached up to just below 141. If you look at this chart overall, it's just ridiculously overbought. I feel very sorry for those retail traders and perhaps even institutional traders who are short this pair. Majority of them being at around 125, 126. So a lot of retail traders holding short positions from this area. This area here, 125, 126, 130. Somewhere in this area here, a lot of institutional traders are short there and are suffering. And I can see the numbers. I've got the data on that. So 1,000 pips out of the money. Terrible. More than 1,000 pips, actually. About 1,300 pips out of the money, the majority of retail traders. But there might be light at the end of this tunnel, so that just shows how far it's rallied. At 141, I think I'm in this one a little bit short, already in this. I sold here at 140.50. Was it 140? I think 140.30 I sold. Again, now I know where the out is. If we get above this level here at 140.80, my stop loss is going to be 141.10. I'm going to move that stop loss to there, and I'll be looking for a move down. Now, it is potentially possible, looking at the longer term charts, I'll show you why. I've had a look at it already, that we could go up to 144. And really, this is annoying. Let's go back to FXCM. There are some other levels above us. They're there to the left-hand side of the chart, going back into before the year 2000. We've got some resistance at 146. We've got some at 144. And this is 147, 148. So somewhere between 144 and 148, potentially even up to 160. So, there's plenty of space on the upside. And if we go back into the 80s, you can see where this pair was in, well above 200. So do we think we'll get there anytime shortly? Obviously not. It could happen, but I don't think so. It's not going to happen overnight, put it that way. I mean, this would take months and months and months. But we've got a bit of resistance where we are now, and that's this line here, that previous resistance there. If I just draw a line across, if you can see where it is, I think you can see the dotted line from my cursor. So right there is exactly where we're at the moment. So there's a little bit of resistance here. Not particularly convincing, I have to say, but it's there, just going back to this little high here. But there's much more compelling reason to believe that we could get up to 147, 146, 144. So between 144 and 147, we should probably see a short-term top at those levels. However, having said all of that, and the reason why I'm short right now is because if you look at the distance from this low where we started at the 200-day moving average to where we are right now, that's about 100 well, 105, and we're at 140 right now, so it's about 35, the difference. And we normally don't get a rally more than, so 35, so 77 plus 35 is 110. So that distance in that little rally was about that distance, 105, 35 Japanese yen. And from here to here is about the same, and from here to here is about the same. So we generally get a correction after a move of that magnitude, even if it's going to carry on going up later. So on the short term, we're pretty overstretched, and at least due for a short-term retracement of some sort. Short-term retracements probably to this red line here at 134. Bearing in mind we're at 140 right now. And then the next one is down here, which would be Christmas for everyone if we got back down to 132. Yeah, 131 and a half. So if we do get a pullback from here, we could get about down to those levels. You can see how far away we are from the 200. Then we've got these other moving averages down beneath us, the 100, 50, and the 20. But bear in mind, we could get up to 144, 145, 146, 147 quite easily. There's nothing stopping it from going there, apart from short-term being, just overbought, really, overstretched, overzealous on the short term. So again, don't be putting all your money in this basket. For those of you who are retail traders or perhaps even institutional traders, and you're short on this pair from the high 120s, you're either going to have to, as they say in South African, in Afrikaans, vasbyt, which means bite hard, bite tightly, clench your teeth, hold on for dear life, or with a bit of luck, and for your sake and for everyone's sake who happens to be short, including myself, but I've got a very tiny position from current levels, we could hope for a pullback into some of those levels where those red lines are, 134, 130, 130. So overall, summary, look to trade. This is my strategy. I don't know if it's right or wrong. I'm hoping that I'm correct. I think it makes a lot of sense, but I'm going to be focusing on range trading the NASDAQ with a bias short. I explained that earlier in the video, how to do that. I'm going to be focused on gold, on being bullish on gold, with bias obviously bullish, buying into dips. I'm already in gold with about half of my position. If we get a dip back down lower, I'm going to start adding some more to that, little bit at a time. But overall, I like gold. That's gold NASDAQ. When it comes to currencies, I'm in the pound against the US dollar, against the Canadian dollar, and against the South African rand, and the Swiss franc. So pound against everything. Euro, I'm not particularly interested in right now, but I'm willing to range trade that, buying dips, selling rallies until we see some evidence of a change in trend direction, which could happen which probably will happen this month, because after Labor Day, remember it's Labor Day on Monday, that's tomorrow, making this video on Sunday, so Labor Day, markets will be very quiet, they will be open during the European and London session, and then some brokers will be closed, Forex brokers and particularly commodities and stocks and so on will be closed during the US session. Most brokers allowing you to trade currency will probably be open during the US session, but it might be quiet. Some brokers for Forex might even be closed during that period, so just remember that. Wednesday, I think it is. Let's just have a wee look, see what's coming out in the news. Yeah, so let's just have a look at the economic calendar. You can go and get this at myfxbook.com. It's free. I think you've got to sign up, basically give them your email, and in return for that, you get access to it. You go to economic calendar. You can have a look at all of this sort of thing over here. What's marked in red is of importance. What's marked in green is not that important. And then you get, well, it's low importance, medium is orange, and none is gray. Sometimes what they mark in as important is not always the right thing. Sometimes when they mark something as unimportant, it actually is important. So Go through each one individually. Don't just go on reading the reds, which is exactly what I'm going to do. Just go through what's happening in this coming week. So Monday we've got, let's have a look at the red ones. Australian dollar, PMI, purchasing managers index. We've got, let's just have a look, anything. I just want to actually see when this inflation number's coming out. We've got S&P, PMI for Europe and Germany on Monday. Retail sales, this is all on Monday. That's 11 a.m. my time, so it's 9 o'clock, 10 o'clock, thereabouts, London time. 10 o'clock. Retail sales in Europe, so that's all pretty interesting. They expect that to be slightly improved, actually, but that's just by the by. Tuesday, let's have a look. Interest rates in Australia on Tuesday. That'll be interesting. Expected to raise by 0.5%. But apart from that, September the 6th, we've got PMI in the US, ISM, so important stuff, but not the main things. What I'm looking for is the CPI. So Wednesday, we've got GDP in Australia, we've got that. Retail sales in Italy, I assume. Unemployment or employment in Europe. And I wonder if we're getting, CAD balance of trade, USD balance of trade, Bank of Canada interest rate decision. That'll be interesting, expected 0.75. So that'll be, if it is that high, it'll be pretty bullish for the Canadian dollar. And we've got Fed speak from Brainard. What else have we got? All right, so Thursday. So somewhere along here. Yeah, so we've got ECB interest rate decision. So that'll be interesting, actually. That's on Thursday. So the ECB interest rate decision is obviously going to affect the euro. We've got jobless claims. Powell speaking again on Thursday. And I thought that we were going to get the inflation. Let's quickly go and have a look at this. Yes, so that's on Thursday. No. Let me just have a look here. All right, so I thought the inflation rate for the US was, I've just Googled it, was going to be this coming week, but I was completely wrong. And just by looking at Google, it's going to be September the 13th, the US inflation data. So that's the following week, 8:30 a.m. EST. So that's September the 13th. And so that's it's Wednesday, I think. Not this coming week, but the next week. So we can all breathe a sigh of relief about that. Okay, so there's not much else on the economic calendar. And there's a couple of things that we saw there. We've got a bit of news from Australia. We've got ECB interest rates. But generally, the big one, the one that's going to move the markets the most, will be inflation rate. And that's the following week. So we don't have to worry about that this week, at least. And we can focus on predominantly the technicals, perhaps apart from the ECB interest rate announcement. So that's it really in a nutshell. I hope you found that useful. So you've got my strategy, my ideas. That's what I'm going to be trading. I've told you about NASDAQ. I'm going to be trading, range trading that with a focus on the bearish side. I've told you about gold. I'm going to be buying that with a focus on the bullish side, obviously. The pound, I'm going to be looking to buy the pound against the US dollar, against Canadian dollar, against the Swiss franc, and against the South African rand. And really, that's my main focus going forward. and I'm prepared to be nimble and quick and a bit ninja about my trading, really. I'm normally a bit of a buy and hold trader, but I'm going to be doing quite a lot of scalping on gold and NASDAQ, probably. The other thing is natural gas. As I said, if you want to find out a bit more about that, leave some comments below. I'll tell you about my strategy on natural gas and what I think about that. And the other thing is dollar yen. As I told you, I'm in a small short position, but I'm willing to get out of that. And you can look at dollar yen, you can look at euro yen. Look at both of those. Have a look at what I've just said in this video. And if you're going to be taking a trade on those, it's probably worth a little go. It's probably worth a go. But you need to be in with small positions and be willing to get out quickly above those key levels, which I mentioned in the video. But the nice thing about those two currencies is that you can get in with very small positions, and if it does go in our favor, we could get some very dramatic drops really quickly, which will make up for the small size of those positions. So basically, you can get in for much lower risk for the same potential gain as a normal, let's say, full-size position. Well, I hope you found that useful. The next video I'm going to be making today will be talking about my $100,000 trading challenge, and keep an eye out for that. And again, please like and subscribe to this channel, particularly subscribe and also hit the notification bell, because you will get notifications the moment I update and upload new videos, and you'll get a little alert to your phone and your iPad and your laptop and your desktop, and really you'll get the info as soon as it comes out. So that's it. Hope you've enjoyed it. Let me know in the comments if there's anything else you'd like me to talk about. I'm willing to talk about anything, really, mostly related to currencies, but if you want any life advice, I can give you plenty of that as well. And just let me know if there's anything, and I'll speak to you soon.